J. Calculate the effect on operating income of a make or buy decision. Make or buy analysis compares relevant manufacturing costs with the purchase price. Only avoidable costs are included in the comparison. If internal production avoids costs greater than the purchase price, the company should make the product. Otherwise, buying is preferable. Fixed costs that continue regardless of the decision are excluded. Avoidable fixed costs are included. Opportunity cost of alternative use of facilities must be considered. The decision that results in lower total relevant cost increases operating income and enhances financial performance. K. Calculate effects on operating income of selling or processing further and dropping or adding a segment. Sell or process further decisions compare incremental revenue from further processing with incremental processing costs. Joint costs incurred before the split-off point are sunk and therefore irrelevant. If incremental revenue exceeds separable processing costs, further processing increases operating income. Otherwise, the product should be sold at split-off. Drop or add segment decisions require analysis of segment contribution margin. Only avoidable fixed costs are relevant. Allocated common fixed costs are typically not relevant unless they change. Accurate incremental analysis ensures decisions enhance overall profitability rather than distort performance measurement. L. Identify effects of changes in capacity on production decisions. Capacity constraints create opportunity costs. When resources are limited, producing one product may reduce the ability to produce another. Contribution margin per constrained resource unit becomes the key decision metric. Firms prioritize products generating the highest contribution per scarce resource. Idle capacity reduces opportunity cost concerns. In such cases, incremental analysis focuses mainly on variable costs. Expanding capacity may require additional fixed costs. These must be included if they are avoidable or incremental. Understanding capacity effects ensures optimal product mix and maximized operating income under constraints. M. Understand impact of income taxes on marginal analysis. Income taxes affect net benefit of decisions by reducing after-tax contribution. Incremental revenues and costs must be evaluated on an after-tax basis when relevant. Tax-deductible expenses reduce taxable income. This lowers the effective cost of certain expenditures. Non-deductible costs require careful evaluation. For decisions involving asset sales, tax effects on gains or losses must be included. Incorporating tax implications ensures realistic profitability assessment and avoids overstating economic benefits. N. Recommend a course of action using marginal analysis. Marginal analysis compares incremental revenues and incremental costs across alternatives. The option yielding the highest positive contribution to operating income should generally be selected. Quantitative results must be combined with qualitative considerations. Strategic alignment, risk exposure, and long-term implications are important. Avoid including sunk or irrelevant costs in analysis. Consider capacity constraints and opportunity costs where applicable. Well-supported recommendation clearly explains financial impact and aligns with organizational objectives and risk tolerance.